friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and I have a really exciting interview today. This is one that I've been trying to put together for a while, and this is with my good friend, Rob Pieklo. Rob Pieklo is the COO at AFR and recently went through the process of acquiring AFR and kind of back at AFR after some time. So we're going to talk about that, and then we're going to get into maybe some more complex discussions. I'm just going to warn you guys, some of what we're going to talk about is complicated, but if you're a mortgage nerd like me, you're going to love this episode because we're going to unpack a lot of stuff. You know, one of Rob's passions and one of the things I love about him is that he likes bringing, you know, some of these more complex ideas that happen behind the scenes to the public. He educates brokers and whole, you know, people that work in the wholesale channel through his podcast. We're going to talk about that. But he likes taking these complex topics and making them understandable to real people. And that's what we're going to try to do on some of these topics today. So Rob, thanks for joining me on Market Shares today.
Oh, thank you so much for having me too. I'm like the least famous person to ever be on here. I saw the some of the sale. I was like, oh my God, it's amazing. Like Renee's on there, and then you get me. But I appreciate you taking the time to work with guys, the little guys like me.
Yeah, well, you know, I'll share a funny. So I first met you virtually on Clubhouse. So if anyone remembers Clubhouse, which none of us go on anymore, but I first met Rob in a Clubhouse room, and during COVID, you know, we had nothing else to do. So we were all in Clubhouse all the time. And there were some really cool mortgage rooms that popped up. And I remember the first time I heard you in a room and you kept chiming in. And I'm like, who is this guy anyways? And why does he think he's so smart? And then the more I listened to you, I'm like, actually, this guy's pretty gosh darn smart. And then I really became like, I'm looking for you on Clubhouse because I wanted to hear what you had to say, because you always bring really good intel into any mortgage conversation. But let's start off with this AFR thing, because this is big news. You know, I'll tell you, I'm not a broker. I've been in the IMB space for a long time, but we've always brokered loans. And when I think of AFR, I think of like kind of a niche kind of a lender. They did a lot of, you know, manufactured homes and some of the products that other people didn't do. You know, and that was, you know, at least my perspective as kind of a person who doesn't do a lot of wholesale business. But that was, if someone asked me, well, what do you know about AFR? That would have been my response. But you worked there, 14, 15 years ago, and then had an opportunity to work with a fund to actually go purchase a mortgage company, and AFR, you know, was kind of in the market to potentially be acquired, it sounds like. But since then, sounds like you're kind of reinventing what AFR is. So I'll let you tell the story in your own words, but I think we'll start with that, and then we'll get into some of the more complex questions that I know a lot of people in the mortgage space would love to hear your perspective on.
Oh, thanks, Tony. Yeah, do we have 2 hours to go through the whole story?
No, you got to give me the Reader's Digest.
We'll keep it short. So with AFR, it's where I grew up, right? It's where I learned the business. It's where, you know, I was able to contribute to the Clubhouse with all the things that I've messed up during my career, right? Like I didn't know how to securitize, and we learned that here at AFR. Ran a retail division, ran that here at AFR, learned about how that works, having loan originators, created a consumer direct division, created a new brand. We created something called the eLend here at AFR when I was here. And then in 2017, I was running strategy, and we decided to I decided to leave AFR to kind of grow on my own and do something a little bit different, and sold my shares of the company back to the shareholders and left, and went and ran originations for a company called Ditech, a pretty large aggregator at the time. We did, you know, I think we're doing like 5,000 loans per month, and I got to oversee all those channels. And then went into the broker world. When we sold to Ditech to Newres, went into the broker world, opened up my own broker shop, small, kind of back to origination roots, learned the business, saw all the wholesale lenders, and then bolted on to a pretty large non-delegated lender. And then I had an opportunity with a friend from high school, always comes back full circle, had left a very, very large, actually the number one aggregator of Ginnie Mae securities in the country, had left there and went to a fund, and that fund had an interest in an originator. And I knew that AFR had always been talking about potentially selling and doing like some kind of investment opportunities. So they asked me if I would consult, find a target, and it was pretty easy. I was like, let me call my friends at AFR, and they started talking, and we figured out a plan. And then towards the end of that discussion, the fund asked me to step in and lead the charge. So I got to come in as COO at when we closed on the transaction in February, help them raise the final bit of capital for the transaction itself. Came here and report up to an executive board at the fund as COO, and really full circle moment for AFR. And it's a little different company now, 5 years after I left, or almost 6 years after I left. But yeah, we were known as a niche lender, and we're trying to keep that as a good foot in the door. Just like, your originators love having a product that maybe other people don't offer, gets them into the real estate office, potential start of a referral relationship. But then you have all the other stuff. And so that's our kind of thesis right now in our space is, hey, we're the niche. We can do that. We can do our one-time close and renovation loans. We can do those things for you. But have you taken a look at our pricing? Have you taken a look at our conventional? Have you seen our USDA? So we've really kind of gone out, and the last 6 months have been a whirlwind.
Yeah, so not really getting away from the roots of what made AFR kind of a household name in the wholesale space, but expanding on that and using those relationships, or like you said, even those niche products to get people in the door to take a look at all the other things that you've done. And it sounds like you're really focusing on those other areas too, to be aggressively priced with your conventional loans, your standard government loans, and everything else. And then also continuing to work on your technology and platform to make it easier to do loans with AFR. I did see an interview that you did, Rob, and you were talking about really also working on the culture, meaning the culture of service, to the industry. I think that, when you're kind of a niche lender and you're one of the few out there that can do a particular product, not that it was intentional, but maybe you kind of rest on your laurels because you're like, well, where else are they going to go? But if you really want to be that service leader, well, there's got to be intention from the very top of the house to focus on the customer service, and the customer is the broker, right? And so sounds like that's been a big part of what you guys are working on as well.
Being absolutely obsessed with the experience. That's how I describe it. There's no other way to do it. It's like, hey, instead of being in the position of saying like, you're lucky I'm here to do this loan because we're the only ones that do it, right? Which is what you're getting at, which happens all the time in our space. We have to flip it around, and be incredibly grateful. Geez, you have a broker that gets a loan. You know how hard it is to get a loan out there. Originators know how hard it is to get a loan. And you turn around, and in the broker world, they have 250 options. They chose us for a loan. Like, why wouldn't I be incredibly grateful for that opportunity and like want to crush for them? Yeah, that's it. That's like, I'm not good at originating. I tried. I went out there, I thought it was going to be easy. I was like, I know all my stuff. I know how the whole thing works. Then you're like, oh my goodness, it's hard to get a loan to come in and stick, right? It's there. And that's what we're treating it as. I know how difficult it is. We know the work that has to go in to get one in. And we know that trust factor of how grateful we should be that someone tried and is putting all their eggs in our basket to get it closed. And it's been a lot of fun talking to the team. And you thought, like, with the amount of people that we had, we've probably brought on about 20 or 30 new people to the organization. We haven't like cut a ton of people at all, but people who didn't fit the vision aren't here. Very small number, but everybody else is in. Like, they're in, and we've turned to the fact of being like, oh my God, that's right. We should treat our customers this way. This is how it is for a loan. We should be, reacting that way versus the other way around. Which, again, same. It just happens in our business. We happen to be the only one doing a certain type of loan.
Yeah. Well, I remember, I had met you around the time that you were starting your own broker shop and doing retail and stuff. And I remember thinking, man, this guy knows everything about mortgage banking, it seemed, and he's going to go originate loans. So I'm glad that you found yourself back in a seat that really capitalizes on your expertise, your passion for what it is you're doing. So I would just say congratulations on, this journey that you guys are starting here and that you're in. And it feels to me, knowing you, I would say as little as I do, that it is a really good fit for where you should be in the mortgage space.
Yeah, I think so too. And it's funny, the origination part I would never get rid of though. Like, I would tell you the experience that I've had, and it's always part of the master plan. Like, I wasn't going in saying I'm going to originate for the rest of my life. I went in saying like, I want to see what it's like now. I've done the 2003 to 2006 origination, business, led, different groups in it. And like, I want to see what those front lines were like. I want to see if the wholesale channel had as big of an opportunity as I thought. and it does. So having this set up and going through it and recognizing how hard it is out there, getting loans in, I did okay. I didn't do too bad, but
Yeah.
that part, like I said, I wasn't a star originator for sure, but getting that in and having some loan officers that work with us and like experiencing that, what the wholesale side has to offer, we think there's just incredible opportunity there. And we do a lot of work with larger IMBs that don't want to do the niche products as well. We do quite a bit of one-time close and reno with those larger retail companies. But our investment thesis for the company was to really go after that broker channel that needs some more options that are willing to invest in it.
Yeah, no, that makes sense. All right, well, let's dig into some of the list of questions that I had for you. Besides being the COO of AFR, and your background is really in the capital markets space, or you have a lot of knowledge in capital markets, secondary, and those things. And so usually when I reach out to Rob Pieklo, it's a question about capital markets or secondary or what's going on. So the majority of my conversation is going to be around those types of topics because I think that it's something that people have very little exposure to. If you're an originator, it's like your capital markets team often is like the man behind the curtain. Like you don't know what's going on back there. And you see things in front of you that just don't make a lot of sense. And they're real head scratchers. And sometimes you think, man, I'm being deceived about what's going on with rates, or, none of this makes sense, or my capital markets people are crazy. But the reality is that could be true. But it also could be that there's just some craziness in the market. And so understanding kind of how some of that works, I think, is important to people. So I'm just going to start with my list. These aren't in any particular order, and some of them might overlap. So bear with me. And this is where it's going to get a little complicated, I think, at times. But I think Rob does as good a job as anybody at making this stuff as simple as it can be, because it isn't simple stuff. So there's no way to make it super simple. But the first thing that's on my list is just, these major differences that we're seeing between certain note rates on our rate sheets, right? So, talk about, we see inversions, obviously, and some of those are obvious. You get really high in the note rate stack and you start seeing pricing get worse. And it's like, we've never seen that happen before. But even, deeper in the rate stack, you'll see, the difference between 6 1/4 and 6 1/8 is like this huge spread. And we often have, I've had a number of loan officers that are asking for pricing exceptions for a certain note rate. And I'm like, well, did you just look a little bit farther down like if you improve the rate, you can get less of a pricing exception and charge a little bit of discount to your borrower and give them a significant better rate. Like these don't seem like normal times as it relates to that. And, I know some of the reasons why it's happening, but I'd like to hear it from you and why is that? And is this something that we should just come to expect moving forward, or is it unique to the time period that we're in right now?
Yeah, great question, and one I get all the time, and I scream this: open the stacks, like open up your stack. Don't please. The pricing engines are broken. A lot of times they'll just price something closest to par. And then you look at it, someone will be like, I'm going to lock, 6 1/4 today. And then you're like, did you look at 6 or 5.75 is actually, an eighth behind, or just really for 10 bips, you can get this. It's the very unusual time, specifically. There's two areas where it's a big difference, and that's in Ginny. In Ginny on the quarters, you're seeing it a ton. So if you're looking at
Ginny's your government loans, your FHA, your VA, your USDA. Yeah. Yeah.
So when you're looking at all your government loans and you're looking at the quarters, you have, there's only on loans on the 6 1/4 and 5.75 or 6.75. Those note rates have optionality in which coupons they can go to. So a real good example is if you went on like MBS Live or you went on your MBS Hybrid, whichever you guys use, and you look at the rate stack and look at the coupon stack, you'll see that the difference between, let's just say, a 5.5 coupon and a 6 coupon might only be 50 basis points in price. So what happens is they'll, instead of taking that loan, let's just use 6 1/4 as an example. So 6 1/4 can go into a 6 coupon, or it can go into a 5.5 coupon. So what they do is they take, instead of having that loan go into a 6 coupon that's paying 50 basis points more, they'll hold more servicing, which has a much bigger value in that loan, and put it into the 5.5. They'll put into the 5.5 coupon. Then overall, the pricing is much better at 6 1/4 when they slot down into coupon. However, you can only do it on those quarter note rates that we're talking about. So when you go then and look at 6.375, you can't put that into a 5.5 coupon. So you have to put it into the 6, which pays less, which is why you see a 6.375 pays less than 6.25. We all think we grew up in a time where things were linear in nature, where it went up in rate and you went up in price. It was this line that went up, and every eighth was about a quarter in price, and you kept going up until it stopped. That's not the case anymore. With the optionality and coupon, you're seeing this huge disconnect in what's happening. So what's happening there is simply they're keeping more servicing strip that has a much more higher value in it. And when you pass that along only in those quarters, you see these huge anomalies in price. That's why you always have to open up the rate stack and look at the 5.75, 6.25, and 6.75 note rates for your specialty, kind of, I would say, the most aggressive pricing you can get in the government space. In conventional, it's very similar. So you have buy down grids, and then you have optionality within those coupons. Not as egregious as the Ginny side is and the government side is, but you'll see every once in a while, you'll see a couple of note rates out of whack, about an eighth or a quarter difference in price. And that's simply the buy up and buy down grids that are provided by Fannie and Freddie that are putting certain note rates into certain coupons for you in with calculation. And you end up with the same kind of anomaly, just not as large scale.
Yeah, that makes sense. Well, and you're right. Most pricing engines will sort to par, so depending on where your margin's at, or even if you're selling par, many people, depending on how things are set up in your company, you may not even be selling par. So here you are sorting your rate stack by a rate you're not even going to be selling, because you might be, your target might be 99.5 or 99, depends on what your strategy is. So now you're pushing yourself into even more, even higher coupons that are probably even more price discrepancy and differences. So
as
you've
you
really
go up, it
thrown
moves
yourself.
a small amount. Correct.
That's right. And so I used to tell people, hey, don't sort, because usually you can either sort by par or you can sort by a particular note rate. But what you're suggesting is really what I tell people today is you got to go into each investor and look at the whole stack and just know where it's at. I mean, you could probably save yourself some time by pricing it 6.25 or 6.75. Like, at least make sure that you're going to get a general idea of which investors are best priced at those coupons, and then open those ones and go from there. But if you're really looking for the best price, you kind of have to open each investor and look at what's available there, because it is going to be some big discrepancies. Now I'm going to jump around because you talked about servicing value, and I think this is an important one to talk on. Like, I understand that if you move into a lower coupon, you're adding servicing value because the servicing value of that loan is more, because in theory it's going to last longer on the books. It's not going to pay off as soon. But even more than that, when it comes to just servicing value in general, what I'm seeing, I mean, let's be honest, no one's originating a loan today thinking that it's going to last for 5 years on their books. I mean, nobody is thinking that, but yet we see servicing values that's saying that, 5 multiple, right? We're seeing like 125 basis points, let's say on average, of servicing value being put into a rate sheet, but no one expects that to happen. And then on top of that, you have people even going higher in some cases. And I think it's in anticipation of them recapturing the refinance of that transaction in the future. So you certain investors that we know are really good at recapture, their pricing's really good right now, but it's because that they expect that to be their future client. So maybe help me understand, like, what, I mean, maybe it's just market competitiveness, but why would I put my servicing multiple at 5, even 4, if I know that my loan's not going to last that long? Is it just so I can be competitive? And then what are your thoughts on people that are really paying up, beyond that? I mean, how important is it to try to compete with them for that business? Or is it just educating people on what the strategy is? And hey, if you don't care if you ever recapture that origination again, maybe go with that guy. But that's what they're paying for, is the right to own your client, basically.
And say goodbye, right? Because they're doing a pretty good job with that. So great. Again, another one that is a big topic. If you, on my AFR market pulse that I put out, we just talked about it on Friday. I had a very long, it was like a 10-minute one, where we went over it and talked exactly that. There's choices to be made. And right now the bids are so wacky and so aggressive But what they're doing is very simple. That for the first time ever, a lot of companies are now taking the opportunity for recapture and putting it into the current value of the MSR. So taking future revenues, which technically a servicing right, an MSR is already. We already know that when you think about a servicing right, it's all it is future cash flows. So future cash flow on a monthly basis. But instead, now what people are going is, well, if I recapture at a 40% rate or a 30% rate or a 20% rate at 300 basis points of margin, why we should start to put that in some level or scale into your pricing and your multiple. And on the flip side of saying, well, why wouldn't you do that? Well, it's like, what would you pay for a lead in a refi market that's captive to you, that is making payments to you? What would you pay for that lead at that time? Would you pay, $1,000, $1,200? Would you pay 1,500 for something like that? That is a very obtainable lead at that time. I think a lot of people would in a market like that. So they're choosing to go that route. Now, for companies like myself and you, I'm sure trying to retain servicing, you look out and go, I might hit this bid. Like this is so aggressive. Like these guys are out of whack when it comes to what the numbers are, what the yield prospect that they're doing for their companies. But they're taking into consideration the opportunity for the refinance in the future. So you have to make a choice as an originator, as a company. Do you want to do that? Do you want to say goodbye potentially to your customer, maybe not just once or twice, that's going to get refinanced, and that's what these guys are doing. And we do see it in our pricing structures. You see it. There's like a lot of nuances to pricing. They want it to be a little bit elevated in interest rate, but not so elevated that it's automatic of a refi. They want it where you can see these par rate adjusters of how they price currently for MSRs. That's why you'll see a lot of times near the top end of your rate sheets, even if the loan did pay a little bit more on the security side, that MSR loses a ton of value at the top. Like you start to see the diminishing value of the MSR is moving faster down than the premium is moving up on the loan. So you'll have this like static point in your rates where even though there's no rates up there, that nobody's really paying any more for a rate above 7 or 7.25 or something. You're just not getting any more premium. But the idea is that they want that loan in the mark where if we see a 50 basis point move lower in overall interest rates, if you can hit that for a refinance opportunity.
Yeah, so people got to remember that there's really this bifurcation of what goes into the calculation of the value of any particular rate, and as the higher the rate goes, the servicing value goes down drastically, and it works the other way, which is why those lower coupons, like you said, are more aggressive. But what about forget about the investment that people are making in the potential refinance or restructuring of that loan or recapture of that loan? What about just the simple fact that multiples right now are at 4 to 5 when we know that that's not going to be the case? Is that just simply what's necessary to be competitive in the market?
No, they're paying up for that opportunity for the lead. And really the yield component of it, if you run a basic model of MSR with regular yield from the cash flows and the durations that these things should last, like you're not gonna be able to get there at the prices that they're paying. So it's part of the calculation. If you do a regular cash flow analysis of this and thinking if the curve is going to move down like we're all suggesting it's going to, and all signs are pointing towards it, where does that put the full duration of MSR? It's probably going to be significantly less than the 5. Because remember, 5x isn't 5 years. The 5x is 5x of the servicing value now that has cost. So you're not netting a profit of the full 25 or 50 basis points, with depending on how you're doing your servicing. You're not netting that whole value. Your portion of that is cost. Probably 8 to 12 basis points is cost in MSR. So they're even valuing at a 5x is really saying 7 to 9 years of duration on that MSR, which all signs are pointing that that's not going to happen. So that's why you're seeing it's a very unique market, I'll say, because if you look at where values are and where pricing is from lender to lender, where there's value is so different in your MSR grid. I mean, you can go look at a grid and have a loan that you'd be like, oh, that one, this company thinks is a 5x, this other company thinks is a 2x, this other company thinks is a 3.1x, and you go like, how could there be that much variance in what someone feels like the servicing value, the rights are worth? And we're seeing that right now.
Well, let's add one more layer of complexity to this since we're on the topic, which is, spec pay, right? So there are some loans that might be originated that would stay on your books for 9 years. One that's like $125,000, for example. I mean, you need to see a pretty significant drop in your interest rate when you factor in closing costs and appraisal and all the stuff that you would need to refinance a $125,000 loan. So we see significantly higher values being paid on these lower loan amounts, right? That's the spec pay. I'll let you talk about that for a second. But well, let's just talk about let's kind of define what spec pay is, and then let's talk about what's changed in the last 18, 24 months with how spec pay is being realized in people's rate sheets and some not. So, but let's start with what is spec pay, and is it purely tied to the fact that there's going to be a longer duration on that loan? The servicing value is more because it's lower, or is there something else going on there too?
Yeah, so it's all based on prepayment of that loan. So we'll think of it that way. So anything that would have a characteristic that would potentially cause a loan to slow down in prepayment speed would be what we would call a story. And you have to piece these stories together with enough, you have to aggregate enough to make it worthwhile for the folks on Wall Street to want to buy it, your broker dealers to want to buy it and sell that story to their investors. So where if you look at standard TBA MBS, which is what you'll look at on any of the platforms, as we see as a standard, to be announced security price that market makers make. They that's the baseline of your business, and everybody wants to set a price at least, so it's not going to be much worse than that, no matter what. That's a market making, a market making scenario for our pricing. Now you have that as your baseline, and if you have a characteristic of a loan, let's just say what if you had $1 million pool, right? A pool of loans. If you had two $500,000 loans at 7%, or 10 $100,000 loans at 7%, which pool of $1 million do you think, when rates dip, is gonna have a higher balance left in 3 or 4 years? So
obviously the lower ones, yeah.
Yeah, the $100,000 loan, it's hard to get enough, to go through the process to refinance and have enough of a rate drop for it to make, move the needle for somebody. What's it going to save them? 20, 30 bucks a month? I know it's only $100,000 on a percentage basis. It's the same, but somebody's not going to act to save that bit of money. But if you could save, $150 or $250, that's another story. Now you're saying, okay, I'm going to prepay, or I'm going to refinance, get a lower rate, and that's going to prepay faster. So the broker dealers are saying that now. They're seeing like, hey, tell me the story. You say, all right, I've aggregated 10 $100,000 loans, and what will you pay up for this particular package of custom securities? And they may come back and say, we'll pay you 200 basis points more, 300 basis points more for that package of loans, because they know that it's going to last much longer and there's going to be longer duration at that higher yield. So why not pay up for it? So they're finding any story. So if you're in New York, there might be a New York story because of all the mortgage tax that's in New York and having to go through a SEMA process to waive that. They'll go ahead and say, it's harder to refinance in New York. Florida has a story because there's a mortgage tax associated with refinancing of about 56 basis points. So that has a story. $100,000 loans have a story. 150, 250 even have a story. So everything all the way up. It used to be you would package them all up, sell the security, and you were done. Now it's like, hey, there's all these different things you have to slice and dice and aggregate enough for them. And the broker dealers are going to look to pay up because they know that's going to last on the books longer, and it's worth paying that extra amount because these things aren't going to prepay as fast as these large loan balances will.
Yeah, no, that makes a lot of sense. So yeah, so you got that. You can just add that to the mix. What I've seen happen, it used to be, and maybe it's because the specified pool, it wasn't, they weren't asking the story, like you said. It wasn't as much of a factor. But what I've seen is that, we started seeing the spec pay revenue start coming in on some of our loans. But then all of a sudden, the market kind of shifted and people started putting an assumption, or at least a percentage of what they expected that spec pay to be upon delivery of those loans, knowing they could pool together, like you said, those $100,000 loans. So in anticipation of that, they would start pushing that better price right into the rate sheet, as opposed to just realizing these extra gains in capital markets, and then keeping some of that, right? Or using it maybe for other ways of subsidizing their business. But nonetheless, we've started seeing it more and more push right to the rate sheet. So now you will see those large pickups on an individual loan just simply by putting in the criteria that, hey, this is a $125,000 loan, and it's a point and a half better price than a $300,000 loan. So what do you think's kind of led to that? And does that stick around, do you think? And I think for someone looking to price out a loan, you got to look for who's pushing in those assumptions, and who's being aggressive about it, right? If you're looking for the best price.
Well, it used to be such a small percentage of the loans fell into a story, and now the stories have widened and have become more like it used to be. You'd get to 100,000 or 150, and that's kind of all there was. Now we're telling stories up to 350 and packaging up these things in $50,000 increments from loan balances. So there's just more of it now, and it's a bigger population of loans are being looked for a story. There's even a story today of just FHA loans in a Ginny pool.
Right.
So if you look at it, if you take a VA, which has very little hindrance to refi, right? Like you can add to the loan balance, you can drop somebody, meet your net tangible benefit, you can move quickly. FHA is a little different story, streamlined. You can't quite just throw it on the loan amount. It has to make sense. They can't bring it. They have to bring money to closing. A lot of people don't have it. So that part. So now there's stories saying like, well, just an FHA loan at all has a pickup compared to a pool that might have VA and FHA loans in it together. So there's all these different stories now, and more stories are out there. So when there's more stories, there's less of the other production to create these pools. So now people are starting to bid up for those particular pools. Why do people put it on the rate sheets? And it's a really weird thing that you're seeing in the market today, Tony. It's that you can't move. So if you have a loan, it's really important to make sure it goes into the right coupon to get as maximized pickup as you can. Nobody wants to pay more for a loan that's at market rate. They're only willing to pay you more for something that's a little bit elevated from market because they want to gain that additional yield for that particular. So they'll pay up for that one. So an example is if I had that $100,000 loan, $1 million pool, if all the loans were at 6.25% note rate, I might see 0 pickup. But if they are at 7, I might see 300 basis points pickup. So now how do you pass that through in a rate sheet? It's not static to note rate. Or to the whole thing. It's static to note rate, and it's coupled by what goes into what coupon. So the pickup might only be in a certain bucket of coupons. And if you price super aggressively, with margin setups and other stuff, you might not achieve the maximized note rate to get the biggest pickup. So that's why a lot of companies used to just kind of keep it, trade it, and then if it was elevated, they would make more money as a company. And do that. But things have gotten so competitive and there's such a lack of premium in the market for a regular loan that they need to put it through to be able to get to margins for that. Because it's hard to tell someone their par rate is 2 discount points. So they had to pass through the lack of premium.
So we could have offsetting things here, right? Like you could pick up servicing value by going into a lower coupon, like you were explaining earlier, but you get more spec pay if you go into a higher coupon. You kind of have potentially these competing revenue sources that cancel each other out in some case, I would imagine. And so now you're thinking, well, gosh, where's all my spec pay? And it's like, yeah, well, we had to go into the lower coupon. We picked up some servicing, but we lost some spec pay, right? I mean, these things, that sounds very complicated.
It is. It's awesome. This is why I love talking to you, Tony, because like you get it and you understand it because they're inversely affected. So like when we have a rally, you'll see spec pickup. And then if you're looking at a pipeline value, you see like, oh, if things rallied, my pipeline should be worth more. And everyone's like, well, it's flat. Well, it's because my spec values rallied a little bit, but my MSR went down because if we moved down in rate and now that's closer to being something no one wants to pay up for. So like exactly right. They're inversely affected in terms of price. And a lot of times when you're hedging and doing that, you have to put that into your model, but spot on. This is why a lot of companies weren't doing it before. It's very complex.
Right. Well, and the challenge is the more that it becomes a little bit more, I guess, mainstream, not that anything we're talking about is mainstream, but as it becomes mainstream to those people who understand it, they want to start thinking of it in linear terms like we used to with interest rates. Like, oh, well, spec should be, I find myself doing this. Well, the spec should be X amount for this size loan and the servicing should be X amount. And I'm trying to think that it's simple math. And what you're telling me is there's nothing simple about it on each specific scenario, that they could be offsetting each other. So it's almost like, it's like a blessing and a curse to learn this stuff, right? Because you go, gosh, now I know a little bit more, I feel a little bit more educated, but it just pulls back a whole nother layer of potential complexity that for the average person, even a pretty smart person, when it comes to understanding this stuff, our ability to calculate what it might be in any particular scenario is next to impossible until the actual delivery of that particular loan happens, right? And
we've created full-on reports that are called value at risk reports for us to say like how much is floating in spec, how much is out there, because you want to try and eliminate that value at risk. So you price a certain way, you expect a certain margin, and you pass it through in your rate sheet, give it to the broker, give it to the LO, and you need to figure out a way to hedge that. You have to figure out a way to get rid of that value that's at risk, because the spec world, it isn't constant. That's the difference. And that's why originators sometimes will complain that it might not be on a rate sheet for a company. And why do you not pass it all through? This other company does. All it takes is one time getting burned, where you think you're making 300 basis points extra on a spec. You pass through 300 basis points and something happens with the velocity of the market, which happens all the time. And people get a little skittish. All of a sudden, that 300 basis point you expected ends up being 140 basis points. Well, you don't go back to the LO and go, by the way, I'm going to come back and let's get back that money from the borrower, actually, some with discounts after the fact. It's over, right? And you just lose. There's no offsetting piece. The MSR is not going to move 140 basis points as an offset. That's not going to happen. So you have these risk factors that are in there that companies have to be careful, and it will happen. It's going to happen. So those that go out and put it all in there and aren't hedging, aren't selling forward their packages as best they can and de-risking their portfolio, they'll get burnt, and then they'll stop passing it through, and they'll have that story to tell of saying, hey, we can't pass through because it went away one time. And that's what happens in markets.
Yeah. Well, look, I think for people that understand this stuff, even at scratching the surface, like, have some grace on your capital markets team. Like, they're doing the best they can. I mean, this stuff is super complex. All right. Well, let's shift a little bit. We're gonna stay in the same vein, but we're gonna pivot a little bit, and let's talk a little bit about. I did a podcast 2 weeks ago. I was talking to actually the CEO of our company, and we were talking about this spread between the 10-year and where we see MBS at. And historically, that spread was well, I don't know what the spread was. You might know, but I do know that right now that spread's like 180 basis points or something like this. It's been as high as like 200 basis points. Or I guess it was close to as high as 300 basis points at some point. Yeah. And so that's come down a little bit, but it's still quite a bit higher than historic numbers. And, we were kind of hypothesizing that if that number does come down, that not only are we going to see, rates get better because we know that MBS, loosely follows the 10-year, but then we also see the spread between the two get back to more normal levels, that maybe we even see a more significant drop in mortgage rates. But we were talking about this a little bit before we came on air. Like, there's some things that might keep that from getting back to historic norms. So let's talk about why is that spread there? What factors are in there? Is it going to close a little bit? And what would cause it to do that? And why do you think it might not ever get back to these historic norms that everyone keeps kind of referencing?
Yeah, this is why sometimes the talking heads in the MBS world bother me a little bit, because it doesn't equate down to the originator what's really going on. Yeah, the spread is wider, 100% of where it was. But also, you got to remember, if you're especially comparing in like the modern mortgage era, when Fannie and Freddie was the most prevalent in our space, and if you look at it, previously, I mean, we're old, Tony. We could talk about this stuff. Like, back in the day when we originated, like, there was, when you did a loan, like, you got to prove Fannie, you got a rate. Like, you were okay to go Fannie. There was no like, oh, let me look at my FICO LTV grid for the adjustments. It was just simply You were Fannie, you got 6.25. So that was it. There was no a way of having different rates and different grids and LLPAs and other things like that. So you have to remember what's happened over the last 20 years is that we've added a significant price increase based on LLPAs and risk factors that they put in place in post-crisis. And then you've added the factor that the G fee's down up a significant amount. When I started in the business, the G fee was 19 basis points. G fee is basically a subsidized fee that comes off of rate, not off of price, off of rate, that's collected on every single loan that Fannie or Freddie originate or buy. That G fee is an insurance policy. We'll just say it covers risk of maybe more risky loans. It comes off the top of every loan the same. That used to be 19 basis points to rate. Today, it's upwards of 50 to 56, 57 basis points on every loan. So if you're talking about spreads and comparing the primary mortgage rate that's being offered versus where the 10-year is now, you have to take into account that the fact that just in general, the agencies have raised the G fee, which ultimately creates this larger spread no matter what. So it's 30 basis points or more of spread just because the agencies have changed that G fee. And it happened with a payroll tax stay during the Obama administration. And then all of a sudden I was like, wait a second, we can do this? This is it's a tax on homeowners, but we can do it. No one's really saying anything. Okay, let's do another 10. And let's see what we have. Let's see what we can do. And they've never lowered it. So besides all these things that are happening and all these affordable initiatives and all the stuff that everybody talks about how do we help housing and affordability, here we're sitting at a G fee that's the highest it's ever been. They've created some parity now where, small guys like me can compete with the big guys, when we're selling. So I love that part of it. But the G fee part of the spread and LLPA part of the spread isn't discussed. And it has to be a piece of it. Now, do I think it'll tighten? Do I think that the spread will tighten? Yes, I believe it will tighten. I think MBS will start to perform compared to Treasury a little better, especially lately. We haven't seen it perform as well. That should tighten a little bit, but we're not going to get to where it's in 100 basis point range or anything. It's just can't get to that spot based on the fact that we have these additional fees going into the primary rates.
Yeah, that makes sense. What made it? It seemed like it really widened up after kind of COVID. What was this? Was it just around the fear of the performance of MBS versus the security of the 10-year? I mean, that has to be a factor, I would imagine. I mean, if I'm an investor and I'm buying MBS and there's some massive mortgage meltdown again, and which I think some people thought could have happened, when COVID hit, because it seemed like that's when it really got close to like 300 basis point spread, and then it never really close the gap all that much. I mean, is that a factor in it? Is just the performance of those, or the fact that there's not as many dollars out there chasing bonds, and we're getting a high yield on the 10-year, so we might as well put our investment dollars there? I mean, is that kind of the
how much regular business does the private market provide right now? So you have to think about it. If you're the only game in town with your partner down the road who are buying a ton of at the time, 70-80% of the business was flowing through Fannie or Freddie with no private market to compete, besides maybe some banks choosing to portfolio a small number of loans, which really is a rounding error when it comes to production. And it was a way to they raised fees. They created a second home LLPA adjustment. They created investment property additional LLPA adjustments. They created the 740 FICO score putting 20% down has an LLPA adjustment that has literally like a 0.0001 delinquency rate. You can't tell me that's a true risk factor. Like, they just added and added and added to help maybe subsidize some of the other programs partly.
Right.
But the pieces listen, even through all the struggles of the mortgage industry, go look at the GSE's quarter over quarter performance. And Fannie Mae had 28 straight quarters of profitability. Fannie and Freddie had $5 billion of profits last quarter combined. So
through one of the worst mortgage markets we've seen since the crash.
Not for them.
Right.
For them, and
well,
in that way.
I'm glad you brought this up because, and I don't know what your prediction on if there'll be any changes to this. I mean, I was talking to a loan officer yesterday who told me, I don't know the exact LTV, but a cash out refinance between a 740 and a 780 had 100 basis point spread.
Different. Can you tell me the difference between the two credit profiles?
Right. 740 and I think it was about even 750 and 780. It's like there's no difference in the performance of this loan, but there's 100 basis point difference in the price. I mean, it's
whether or not he swiped his Amex that weekend.
Right.
That's it. Exactly. Between the credit profiles, you can't tell me there's that much of a pricing discrepancy in the risk factor of that loan.
No, it's absurd. Well, I think it's a big part of this because we talk about rates coming down and all this refinance opportunity. But when you start looking at LLPAs, because they apply on rate term refinances as well, it's not just cash out, but the cash out's pretty egregious. But we talk about debt consolidation and all these opportunities. I mean, I don't want to say that there's not opportunities. We know that there is. 50% of applications reported by the NBA, I think in the last report, were refinance applications. So we know people are applying for refinances. There's no question. But the amount of people that would benefit from a simple rate term, when you look at the LLPAs, I don't know. I mean, it makes me, I'm not saying there's not opportunity, but it might be less than what people are expecting it to be. And is Fannie and Freddie, is FHFA going to do anything about these LLPAs to try to help people take advantage of this. Is there any talks about that you're aware of?
No, so for affordable, yeah, like there's going to be opportunities for affordable refinances as well. That's going to happen. That's part of their initiative. They've talked about with their game plan over the next few years what it's going to be. It's going to be more affordable. It's going to be going after VLIP, the very low income, and low income people. So that they're going after that business. That's what their mandate is. That's what they're looking to do. They're going to create programs to help facilitate that. I'm not knocking that at all. I think that's great. It's needed. It's what we have. But you're in a tough spot where you may push the subsidized loans out eventually, and you're starting to see a little bit of the PLS come in on investment properties. I know Fannie and Freddie are not in the, or FHFA is not in the business of helping someone get their third and fourth and fifth home or their beach house. That's not their idea. However, those LLPAs are helping subsidize these programs that they're doing. So, with those profits that they have, they're looking to subsidize and put these programs in order and get these LLPA waivers for first-time home buyers, different programs based on income levels of their area. So that's going to continue. You see, they're going to have those products, but the standard regular loans, there isn't talks of them doing something to make it easy through this administration. We'll see what happens, come November and what that looks like. And I would say it's almost, it's even, let's say a little bit scarier if the other side gets in and you kind of listen to Mark Calabria and kind of what his thoughts are and what should happen to Fannie or Freddie. And you're like, oh man, what are they going to do? Like, is this going to be this, trying to push private markets back into the space as fast as possible? What does that do in terms of disruption for the space? But you could see clearly FHFA has a mandate and it's going to be focused on affordable, and you may see wacky programs come up to save a ton of money on a small subsegment of loans. And that's what they'll be doing.
Yeah, I mean, I've seen some of those, I mean, we have some products that are available through Citi and Chase, and I don't know if this is certain CRA stuff or if they're straight from Fannie or Freddie. I haven't researched them that much, but certain census tracts, like you said, very, very low income, low to mod even, but even majority minority census tracts. You're seeing some pretty crazy opportunities out there to help those people, and refinances with no LLPAs, on stuff. So yeah, we are seeing that, but it sounds like what you're saying is we're kind of like the adjustments we see on some of these higher FICO or second home, non-owner occupied. Those are almost like a tax to subsidize some of these other programs. Is that basically what you're saying?
Again, I love talking to you, Tony, because I was just going to say, it's like the states that were testing the water, and you're in New Jersey and they're like, all right, let's another 1%, another 1%, another 1%. Then all of a sudden they go, now you're up to 10 or 12% in terms of a state tax. And they go to hit the button to collect the tax. And they go, what happened? Oh, I'm in Florida now.
Yeah.
Right. So eventually we get to the spot where you're not able to hit the collect button. But hopefully we don't get there. Hopefully the agencies understand that you do need it, not to continue to kind of have a heavy hand in the markets that help subsidize and do their mission statement. You need those funds to be able to do it. So don't continue to make it tough and more expensive. More so, Tony, is because there's not premium. We just talked about it, and it's something that we don't talk about enough in the market. 2020, 2021, the lowest paying coupon, the par rate coupon that people used at par, paid 103.5. You couldn't make any less than that. That was the lowest coupon you had.
Wow.
Today, you're scrambling to get to 101.5 in the security coupon and 102. If you think about it that way, that's the highest you could get. So you have a 200 basis point difference from 2021, when the worst you can do is 103.5, and today the best you can do is 101.5. So you're thinking about that market. The premium has dissipated, yet the LLPAs have all stayed the same. So you have these difficult kind of equations to come up with, and that's why the cash window is so popular with Fannie or Freddie, because they can create a market in the higher note rates to try and get you to be able to pay for some of these LLPAs. Otherwise, it's just more discount for the borrower.
Well, it makes everything harder to pay for, including loan officer compensation, right? I mean, loan officers, let's just say loan officers, I get it. You want to make doesn't matter, 125, whatever your comp is that you want to make. But what you just said is that half of the premium that's available, you're trying to put it towards LO comp and cover all the other expenses with the difference. And there's nowhere to go except for charge the borrower discount. because there's
Yeah,
no premium,
exactly
and
right.
right.
There's no place to go.
Yep.
You don't have a par rate because there's no premium. It's not, you can't just keep going stepping up. And a lot of LOs don't know this. They go, no, no, that's not, just go higher in rate. Eventually it just doesn't pay anymore. It just doesn't pay anymore. So you look at that and you say, oh wow, it can't pay anymore, it doesn't pay anymore. Where does the money come from? And then you add the equation to it, Tony, that we talked about earlier with the MSR. And for a company like us and a company like you guys, when you retain MSR, you're putting a future value of cash flow onto the loan. Well, that's not cash.
Right.
Like that requires significant liquidity to be able to hold the MSRs, because you're saying, I'll pay $1.25 for that today for the anticipation to get $1.25 over the next 5 or 6 or 7 years. But so it has to come from somewhere. So if I'm paying out a broker or an LO as part of it in cash, that means I'm retaining that MSR and I have to use my cash to go. And it's a difficult game to play in a market that doesn't have a ton of premium or a ton of margin.
Well, and I always say you're investing in the MSR because you truly are. You're writing a check, up front.
Right.
You're to make that investment. Well, you know, I don't like to try to push down loan officer compensation, but I also want people to understand how much is available in a loan. I didn't realize it was that 2020, 2021, it was, 350 was like, the least you would make, and now you're lucky if you can make 200. I mean, that's a huge difference. And then anything above that needs to get charged, right? It needs to get charged to the borrower, right? So wow, no wonder why it's so hard to find par rates sometimes, especially if you're in a high margin type of a situation. And look, we see companies shrinking their margin, but we see a huge reluctance on loan officers to do the same when they can directly contribute to, and not all of them, but many of them have realized, like, look, hey, it's competitive out there. There's different models out there. You work with a lot of brokers. There's IMBs, there's banks, there's credit unions. Everyone's competing for a lot less business, and as a result, it's not just that the premiums are lower. People are just willing to, loan amounts have gone up, average prices have gone up. So people are willing to work for less basis points per transaction. But some people just are stubborn and do not want to make that change. And I understand why. I mean, I was an originator, but you're directly impacting your ability to be competitive in the marketplace against someone who is willing to do that loan for less. It's really that simple,
It has to be given. It's all across the board, right? Like everybody has to participate in helping. Sometimes it's the front end. Sometimes it's a broker changing their comp, an LO changing their comp, the company changing their margin, getting more aggressive when there's no premium. Sometimes I'll run something and I'll look at one of our products or programs and I'll say, what's the average comp for a broker in this space? Okay, great. What's the primary borrower for this type of product, whether it's a DPA or another program? And I get that and I look at it and I go, I can't make any money on this loan today, but I'm going to put it out at zero margin because I want to make sure there's a par rate. There's no point in putting out a product that I know the guy can't afford or can't do. So for today, I'm just not going to make money. We make those sacrifices, and it would be great if we don't have a dynamic world where we can change it all the time. Like with LO comp, you kind of have to stay static and do the 90-day changes. It's difficult. But for us, you have to look at that now, where that wasn't a discussion point before, and now I have to start looking at it, going, let me open it up. Can I pass high cost? Like that's the discussion I have to have every day in my product. Is a borrower a 660 FICO? Can I get it through this program and pass high cost this way? And it's stuff that we didn't have to think about before.
Yeah, well, I know we're making those decisions. You're making those decisions, but so is every other lender out there. It's not just I mean, well, I think most of them are, because I recruit for a living. Like, I see everyone's rate sheets. You can do the math. You know where people are. People are. I feel like the lenders are leaning in right now to help capture the business. So all right, well, let's move on from that. So I talked about the CRA, GFE, LLPAs. Nothing's going to change. Nothing's going to change there. We talked about servicing. We did jump around here, so I gotta see what else. Let's talk about fairly recent news. Was we had Jerome Powell spoke at the Jackson Hole Summit, and so I'd love to get your take on his statement there. And then what do you think's going to happen? Because I had read, and I think that it's as accurate, but that the last 3 rates reduction cycles all started with a 50 basis point drop. I don't know 100% if that's true, but that's what I heard. So, and now there's some talk of a 50 basis point drop. What was your take on what Jerome Powell said? Do you think we could see a 50 basis point initial drop here in September? And they're still predicting 100 basis points by the end of the year. And there's only so many meetings yet. So we got to see a 50 at some point. And then lastly, what do you think this is going to actually do to mortgage rates? I think people are thinking it's going to, be pretty swift and pretty significant. But I'd love your take on what it means to my actual rate sheet based on what the Fed does.
Yeah, it's interesting. We all know like the Fed's rates aren't necessarily, they're short-term rates, and it's the overnight, repo rates, and more so than the longer term rates in mortgages. But mortgages take into account the data that goes into these decisions that the Fed makes. And I do think from Friday was a huge win for everybody, because we've been waiting. And I'll throw some dates out there. People remember like May and May 10th of 2023, where there was supposed to be some CPI and all the stuff. Like we kind of go in.
Wait, we can't talk about that. We don't talk about May 10th, man. That's like
yeah. So we talk about, and a lot of people predicted a lot of things. But what we've been waiting for is the shift. I call it just simply shift. And we're looking at it, and the quoted line was I think the time has come for the policy to change or to adjust, I think, right? That was the line that he said. And that's what we needed. Like that's what we've been looking for. That's why I think some of the direction from that day is finally that clarity that this is happening. September's there. And I do think more than likely, we'll see what this jobs report does. It'll have an impact on for in the beginning of September. But we do think that it's going to be 50 basis points. Most of the time when these moves do occur, you see significant movement in the long end, and you'll see potential.
So I don't know when exactly this episode is gonna go out. So we might have the jobs numbers before this episode airs, because I think it's next week, right? But
that's right.
As long as that jobs number isn't way off, you're expecting, even if that were to stay flat from what expectations are, you think we're set up for a 50 basis point cut?
I think we're set up for a 50 basis point move. Yeah.
That's kind of what I think as well. And that's kind of what I've been predicting. I think the jobs number could be the one thing that could maybe pull that back. But okay, so I think
if it does come in different, like, do we believe it? We just had a revision last Wednesday for 800,000 plus. So it's going to be interesting to see. It's not funny. This is terrible, right? Because this isn't the way it should be. But you have to think of it that way. Like, think about you're a trader. Think about this is in our world. We're thinking of the outcome and the result of this is interest rates moving up or down for our business. Can you imagine if your job was to trade and the data was off, and now you have to go on a report? You're like, what the heck is going on? Like, what am I even trading off of? And I'm trying to make an indication of which direction we're going. And here, you can't count on the data. And it took us like mortgage guys to sit there and keep talking about, man, this jobs number doesn't smell right. Like we were all talking to each other going like, we talk to borrowers all the time. This does not smell another big, huge gain. This isn't right. And we kept saying it over and over. And everybody who's way smarter than us was like, no, these are the numbers. And then you have these big revisions. It's funny to see that. But can you imagine if your livelihood depended on trading on this stuff? So it'll be real interesting to see what the September jobs number is, if we have a big miss, and then see how the Fed reacts. And if we see a move, and more so is we've never had more of a technology-driven trading market in bonds. So this isn't the old school. We can't go back and say like, oh, in 2003, this is what happened and this happened here. Like the algos will kick in. And I described that. So whatever has happened in the past, we can throw out the window. But traditionally, you would see the long end move down rapidly, with some velocity after this first move.
Right. Well, yeah, and like you said, I mean, once it starts moving, you're talking about like there's triggers already set up at certain points, and all of a sudden the market will just drop. I mean, I wouldn't be shocked to see, just like we saw when the Feds raised rates, we saw some pretty huge 100 basis point days, 150 basis point days. I wouldn't be surprised to see some of those in the other direction. Now, maybe I'm just optimistic, but I've seen this happen. It's been my first rate cut cycle that I've been through in the last 27 years. And unless and especially with the 50 could really give us some movement because there's still quite a bit of anticipation of a 25. I mean, that's going to price into the market at 100% certainty. But the 50 isn't. And so, that'll be interesting. Back to that jobs number, not only is it ridiculous that they were off by over 800,000 jobs, but think about how the market would have reacted in each of these monthly cycles. And the Fed probably would have already taken action earlier this year had we had accurate jobs reporting data up to this point. So it's really sad, in my opinion, that it's so far off. But what's shocking to me is although the bond market was strong that day, it wasn't like a banner day when that came out. Like oh my God, like you would expect a rally, and then the very next day, we sold off because of whatever report came out that day. I mean, it was almost like a nothing burger to the market, which is shocking to me. And then Jerome Powell didn't even mention it in Jackson Hole.
Yeah, it's amazing, right? That they didn't mention it. Now, if you think about it, the discussion points prior, so about a day or two prior, you started to get some information that they think the revision is going to be 1 million. And I think that's what muted some of it. So we had a little bit maybe of a move.
So the whisper was a pretty high number.
Exactly,
and
1
we
or
were under it.
1.1. And then when we got there and the revision was still jaw dropping, but not to the extent that it had already been priced in somewhat. So you saw that. I agree. I was right with you saying, man, like resistance at 380 is strong. Like it is really strong for some reason. We've been bouncing off that floor for quite some time. And you think about like velocity of move and like algorithms and trading, it's going to be interesting to see what happens. If you think about NFP, I think it was August 5th when the July report came out in August, and then that following, so that was the second, I think, and then on that Monday when there was some stuff going on overseas, we saw the 10-year drop. It was down to 369. Like it dropped all the way through everything and then came all the way back in the same day. You saw this huge move. So we'll see what happens when things start to break below the 380 the second time, and when all the trading platforms start kicking in and see what happens if there's a sell-off in the bond market or something. Like there's something could potential or a lot of buying in the bond market, just say. So we'll see what happens on that. But when the event occurs, it's going to be very interesting to see the reaction. And if we tip below some of these technical resistance levels, can we slide all the way down? Can we move 20 bips on the 10 year? It's quite possible.
Yeah. So do you have a prediction on where you think 30-year fixed rates are going to get to? I mean, are you kind of thinking we're going to end up at maybe not like obviously right after this, but I'm talking in the next 18 months as we see the Fed do their thing over time? Obviously very data dependent here, but are you kind of thinking we land in that mid 5 range at some point at the end of this cycle, and that's probably about as low as we go? Because I think a lot of people are still predicting we get back to the 4s. I'm not there yet. I'm kind of feeling like we get into the low to mid 5s. Maybe that takes a year or 18 months or even 2 years to get there, but that's kind of what it feels like to me. But hey, I'm no expert. What do you have a prediction on where you think they might land at some point?
Yeah. I'm in that spot. I don't think they're going to drop as much as a lot of people expect. I think there's some stuff priced into the market, and to be honest, there's probably going to be bigger issues if we do drop into those levels. That means this is a tough market, tough recession. Something's going to be really difficult in our economy that's going to cause it to push down. So we do want to slow down. We'd like to see rates come down a little bit, things become more affordable. But if it starts to go in and we do get to that 4 handle, that means something's occurred. Like either
something's going on,
some kind of war, even though the war partly is like it'll have an initial effect of dropping long-term down. Then it's like shit, we need more debt. It's going to be go up a little bit, in that part of it. So we'll see, but most times it's going to be some kind of event. And I think it'll have like my anxiety levels want it to be a slow and steady move down, nice and orderly, so totally. I can like sleep at night. But we know that that's not how it works. And I wish. I feel like we'll have these moments of like range bound, like we're in right now, and then boom, drop. Then we'll have it'll creep up a little bit again, and then something's going to happen in big velocity, big drop, and we'll see that, but then end up in like I said, maybe the low 5s is where we would cap out over the next 18 months.
I'll take it. I think we're aligned there, Rob. Well, all right. So you guys, just based on that illustration you just gave, I did an episode talking about refinancing this is going to happen in spurts. Like, be ready. If you're a mortgage guy, like, be ready to capitalize on fleeting opportunities in the market. They will be lower rates over a longer period of time, barring some other change to things. But we know that the Fed's pivoted. They're moving into a cycle. That's a cycle of easing. It's going to last a while, but there's going to be some fleeting opportunities. So make sure that you're ready to capitalize on those. I got some other questions, but I'm not going to get into them because we're way over the time that I wanted us to be at. It's already a complicated and complex episode. But, look, Rob, I think you do a great job of explaining this stuff. And I hope that our viewers that are kind of, want to understand this stuff better got a lot out of this episode. I love talking about this stuff if you guys all can't tell. So let us know if this is, content that you like, and we can always have Rob back and go a little bit deeper. But in the meantime, Rob has his own podcast. He mentioned it earlier, and he does some pretty short, bite-sized episodes, not like some of the ones here on Market Shares that are a little bit more Joe Rogan-esque sometimes. But Rob, you've done a great job. You have a podcast that you launched called Market Pulse. And so maybe just really quickly, where's the best place to find that, and what kind of content can people expect to see there? And you guys, please check out Rob's. If you like this kind of stuff, this is the kind of stuff he goes into all the time, but he has nice graphs and charts, and he'll really help you understand it even at a deeper level. But where can they find Market Pulse for those that want to check it out?
Just at afrwholesale.com, and just right there on the main page, you'll see my ugly mug right there, and then you can click on it and watch. We do have guests sometimes, so I had my head of capital markets jump on today and do a small one. The idea of Market Pulse is to do short stints about what's happening in the market, but then always provide one item of value for our originators. How do we talk about not just coupons? How does it equate to the note rates? How do we talk about MSR values, opening up the stack? What's hot right now in the market? Why is non-owner occupied great for this? So there's a lot of different things that we'll go into. Every episode will have one item that you can have a takeaway versus just being a talking head about MBS. That doesn't do anybody any good. I want to put it to an originator. Doesn't matter what channel you're in. This is for everybody. So you can go in and we'll talk about one thing of the why behind something that doesn't make sense, and we try to make sense of it.
Yeah, and it's also on YouTube, right? Because I found it.
Yes, but that's how you get there. So yeah, you go there and it's on YouTube at AFR Wholesale. You can subscribe there, or just go to afrwholesale.com and it'll get you to the pathway to YouTube.
All right, awesome. Well, Rob, hey, look, I appreciate you taking the time. And I didn't give Rob any list of what we were going to talk about because I knew that all this stuff he just knows off the top of his head. You're ready. You were a great guest, and I appreciate your time. For those of you in the audience, I hope you got value out of this content. If you found this interesting, please share it with somebody. I mean, that's more than anything what you could do to help out the Market Shares channel is let people know about it. For those of you that watch it every week, you're already subscribed. So thank you for that. And I'll see you guys on the next episode of Market Shares. Take care.